Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
Hello, everybody. It's good to see everybody. Good to see you, Hari. How's everything?
Oh, pretty good. Surviving. How about you?
Yeah. Good. In Houston, in Texas, it started to open up. So how is it down there?
Yeah, I mean, I almost every business that I visited is pretty much open. But there are some stores that are still pick up curbside kind of things only. So, it's slowly, I'm seeing it, but we're recording this June 7th or 8th.
7th.
And the interesting thing I saw was this jobs report kind of blew me away with 2.5 million jobs as opposed to a 7.5 million loss. So I think, the V-shaped recovery that people were talking about may actually come to fruition, depending on how things go. And I have heard from a lot of people that the reason they haven't gone back to work is that they're making more money on the stimulus checks. So, they're kind of holding off on going back to work right now.
Mm-hmm.
So
yeah, it's interesting. You got the stimulus kind of byproduct of the stimulus bill, the effect of that, and then also just the fact that people want to. I mean, the businesses are starting to open. You can see that in Houston. You can see that in many parts of the country, at least in the U.S. And I know for a fact that in Korea, like things are already been opening, and so we'll see how it goes. But it seems like we're on our way to recovery. It's just a question of how fast.
Yep.
Over here in California, we haven't really opened up as much. I mean, slowly we're getting there, but it's still taking a while. Yeah. Anyway, today we're talking about Disney. So let's get on with our analysis. Before we do that, can you give us the quick disclaimer, please, Ari?
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not a financial advisor, nor do we know your specific financial situation. So please consult with the appropriate advisor before making any investment decisions.
Fantastic. Awesome. As I mentioned, we will talk about Disney in this episode. And, even before this episode, we mentioned Disney quite a bit in our previous episodes as a company that has strong moat, almost indestructible moat. We talked about, I think we use words like indestructible, like, the widest moat. Anyway, like all these adjectives to describe how powerful the moat is around Disney. I think we will try to add more color to that, maybe perhaps debunk some of it. So let's dive right into our analysis. So right off the bat, like we always do with any analysis, we use our checklist. So our checklist allows us to make sure that we cover all the grounds when we talk about a company. And if you would like a copy of our checklist, please email us at info@valueinvestor.org. So the first thing on the checklist is trying to understand the business, right? Overall business, more of a qualitative assessment of the company. So right off the bat, the first question we ask ourselves is, what does the company do? And, you should be able to answer this question without having a long-winded answer. So I'll turn it over to you, Hari. What does Disney do?
So if you don't know that, well, then you're living under a rock, and
North Korea, wherever.
Maybe investing isn't for you. So really, I think this podcast is going to be a little bit different than what we normally do, and we go on down the checklist because, excuse me, we're going to deviate a little bit because I think the educational part of this company is going to be different from what you would. Than going down the checklist. We go down the checklist a lot, and it's very valuable to do so. But sometimes there's an opportunity to dig into certain aspects of a company that I think will help guide your education. And after all, this is we even say it in the disclaimer. This is an educational podcast, so bear that in mind, because I'm going to talk about the business, and then I'm going to kind of talk about the moat and potential destructions of the moat. as we see it through their finances. So let's get started. Disney operates 4 different business segments, and people are probably familiar with these off the bat. But media networks, the parks and experiences and products, studio entertainment, and the direct-to-consumer and international group. So in the media section, they have numerous brands: Disney, ESPN, Freeform, FX, National Geographic, ABC, and they do TV production and distribution. They also own half of A&E, the entertainment network, or Arts and Entertainment Network, now just called A&E. They also own a significant percentage of Hulu. And in the last year, they bought Fox, 20th Century Fox, to get their various assets. And then they had to sell off the TV stations as a result of that. Or they were not allowed to acquire those. In the media network section, they have domestic cable networks. So you've probably heard of those. We just talked about Disney, the Disney Channel, Disney Junior, Disney XD. They have various channels: Freeform, ESPN, and so on. Which I was surprised by. They don't actually own 100% of ESPN. They own 80% of it, and 20% is owned by Hearst. So broadcasting is also through the so in the domestic cable networks, they have subscribers of around 59 to 89 million, depending on the brand. ABC also reaches almost 100% of U.S. households, and they make money by ads and affiliate fees. So the affiliate fees is, if you're running a cable provider, you have to pay the ABC station in order to run it there. They also own a bunch of studios: ABC Studios, 20th Century Fox TV, Fox 21 TV stations, and they produce the majority of the company and TV programming. And I thought this was really interesting as a kind of a defensive thing, because when we talked about the moat being so impenetrable in the era of streaming, so they have 70 years of production history, 4 seasons. So the way that they describe these as being significant is if they have 4 seasons or more of a particular TV show. So they have 65 shows that are 1-hour dramas and 40 that are half-hour comedies. So at least have at least 4 seasons with those. So thinking about this as putting this all onto a streaming platform, they have all of this stuff. And in addition to that, the A&E network they own 50% of, which they have History, Lifetime Movie Network, and 50% of Vice as part of that. So, that was the media side of the house. I'm going to talk a little bit more about the parks. The theme parks are in Florida: Walt Disney World, Disneyland in California, Disneyland Paris. Then they own about 40% of Hong Kong and 43% of Shanghai Disney. And then they license to Tokyo Disney Resort. In addition, they have licensing deals for consumer goods, and then they sell branded merchandise as well in the Disney stores. I think there are over 200 Disney stores around the country, and the revenue comes from theme park admissions, park merchandise and beverages, resorts and vacation merchandising, and leasing of parks. So the reason I'm digging into all of this is that we're actually going to spend more time on the financial side of the house here, and how they break down. They actually do a very good job of breaking down their various segments so you can get a clear picture. And I want to kind of dive into that to kind of, talk about the moat.
Yeah.
Go ahead, Becco. You have a question?
Yeah, just a clarifying question. So on the very top of that discussion, you talked about various segments. Obviously, media being the first one you talked about, and the second segment you talked about was the theme parks. Was there a third one, or?
Yes, there are 2 more.
Okay, 2 more.
Yeah, studios. So that's the thing you're probably familiar with from the movies. Walt Disney Pictures, 20th Century Fox, Marvel Studios, Lucasfilm, Pixar, Fox Searchlight, and Blue Sky Studios are all part of the Disney label. And as you would expect, they make money off of theatrical distribution. So the movie shows up in the theater, home entertainment, which is DVD and Blu-ray, and then TV and streaming video on demand. And then the last section is actually where the streaming services come into play. This is branded international TV networks, so that they have ESPN internationally. They own various other channels as well, and then direct-to-consumer streaming services: Disney Plus, ESPN Plus, Hotstar, and Hulu. So Hotstar, I believe, is in India or one of the other. It may be part of the Star networks. So anyway, they have a very, very wide breadth and depth to their organization, and they cover just about every aspect of media through their various brands. So
yeah. So just to summarize here, so you talked about the media business, you talked about the park business, studio, and streaming. So there are four segments to Disney Umbrella Company.
Yep.
Okay, great. Thanks for the rundown there. Let's move on to the second question. I think this will be an interesting one. Does the company have a competitive advantage? Describe them in the categories below. So start off with the first one off the bat, a brand. Does brand play a huge role in the competitive advantage and in them sustaining their business, winning over businesses?
So, yes. Next question. Yeah. So the answer to that is yes. They are definitely a top of mind in just about every aspect of every field that you think about, right? So if you're thinking about taking a vacation and you have kids, or not even that young, Disney is probably one of the easiest places to take your kids. I take my kids there all the time. It's a fantastic place to vacation, because they, the thing that people don't really think about is, just imagine if you have two kids, you have car seats, you have all this heavy stuff. Disney picks you up from the airport, takes you to the hotel. You can, you don't waste a day in travel on either side because of their bus system and everything. You can basically stay at the theme park and not have to bring any equipment or anything with you. You just bring the kids, and they take your luggage to your hotel room. It shows up in your hotel when you get there. It is a fantastic vacation package, right, that they set up for you. And the same thing is true about the theme parks. They are very highly differentiated products, right? I can't go and see Cinderella at Universal Studios, right? So if you've got small kids and they watch all the movies, they see everything. My daughter has seen just about every Disney movie at least 20 times. So,
Yeah.
It's a very easy kind of sell for a lot of people, right? When they're planning a vacation, it's a lot of work for me to go somewhere that's not as friendly as Disney. So there's a lot of mind share that they have. Movies are the same way. A Disney movie comes out and they have no problem lining people up. You've probably seen this with Marvel. The Marvel universe has been crushing it for the last 10, 12 years. They own Star Wars now, Pixar. So it's essentially, they have a very big mind share in the entertainment business, right? And that I think all translates down into their brand moat. Like, you hear the word Disney, you know that you're getting a quality product. You're willing to pay more for that product, which is what that moat translates into. So I think it's a pretty easy sell there for me on the brand.
Yeah. Yeah, it makes sense. I just want to kind of mention a couple things that you said there. Brand, obviously is defining, I think, one of the most defining feature of this company, really. And it pervades all segments of the business, right? The media, the park, studio, and streaming, all of it. And you also mentioned a couple of things about park specifically, that it's so convenient. It's so convenient that you have the whole system set up. And so I think we can talk about that a little bit more later. But yeah, like you said, kind of the theme of brand pervades throughout the entire company.
Yep.
And I think they're utilizing, they're leveraging their strength quite well there. Okay, so next question, network effects.
So I don't think that there's any network effects per se here. That in the Facebook or eBay sense of the word, they're a strong business because of the brand, and I don't think that there's any reason that people go to Disney because other people are already at Disney and so forth, right? There's not more value because, in fact, I would like when I go to Disney World for fewer people to be there, right? Because then I don't have to wait in line as much, So
Yeah.
so yeah, that kind of mentality, I think, it doesn't apply to Disney.
Hmm. That makes sense. Now, switching cost.
It's interesting that we bring that up, but they actually do have some switching cost in that there
Mhm.
are people who sign up for their Disney Vacation Club. And so it's not for the entire business, but essentially it's a timeshare. You pay yearly for this timeshare, and then you can cash in your points to essentially, have a Disney vacation. And you don't have to do it every year. You can save up your points and do things like that. So, that's a big component of the theme park. And as we'll talk about when we look at the finances, that's actually the part where people that's where Disney's making their money right now. Is a lot of that is they're funneling all of these assets into people coming into the theme park, right? Because if you think about their business, they promote the movie, right, and then
Hmm.
you go and interact with the characters at the theme park from the movie, right, and then when you've done that aspect of it, then you go buy the merchandise from the movie, and then you can continue to do this year after year after year, long after the movie has probably stopped earning, big bucks. You're still interacting with this property that they've created. It's a pretty, it's a return on capital that is very, very high over the long tail of the property, right? Whereas if you
Yeah.
look at adult movies, right? I'm not talking about pornography. I'm talking about movies made for adults.
Yes.
Those do not have that kind of lengthy lifespan, right? I mean, I can't think of movies that are drawing people to watch it 20 times a year in, a year after they're made, right? That doesn't really exist. Maybe there's a couple of movies here and there. For the most part, that aspect of the thing is so there's no switching cost per se in going to see another movie or something like that, but there is on the vacation side, the resort side, that kind of stuff.
Hmm. Yeah, that makes sense. And I think we can explore that a little bit later. But the aspect, I think the defining characteristic of Disney movie is that their target audience, right? I think that's something that is kind of overlooked in a lot of the analysis that I find online, which is that we're talking about a children's content, and by definition, just because of the consumer behavior of children's how children's consume media, it's quite different in terms of the lifetime value of a customer, and a lifetime value that we can extract from a product.
Yeah, and I think even think about this, like your 3-year-old doesn't go to Disney World by themselves, right? So if you go to Disney World, or the 3-year-old is the one who goes to Disney World, it's mom and dad and the older siblings that are also going too, right?
Hmm.
So when you watch a movie for an adult, you're buying 1 or 2 tickets, right? When you're watching a children's movie, you're buying 4 tickets or more, right? And so that's kind of the there's a kind of a built-in effect here that maybe the parent doesn't want to necessarily go see that, but they end up going and seeing it anyway because it's a they have to supervise their kid, right?
Yeah.
Now, for the
So
most part, adults also enjoy those movies too, but they may not seek it out if they didn't have the children, right? So
yeah, for sure. Okay, let's move on. Next one is low cost.
so
Anything here?
no, I don't think so.
Okay,
I don't want to waste too much time on that either. So
sure. And then last one is intangible assets. This is kind of getting a little blurry with stuff we talked about up at the very top, brand. Any intangible assets that contribute meaningfully and materially to the business here.
So yeah, I do actually think that they have some fairly significant intangible assets in that, Disney as a company has and you can chalk this up to brand, you can chalk this up to other things, but this is a very labor intensive business, right? That they're in, right? These theme parks require tons and tons of people. They have over 200,000 employees that work for Disney. What you see is, and these are people that are working for, you know, um, $15 to $20 an hour, $25 an hour, depending on, so they have fairly significant assets that they deploy, because of the brand and the icon that they've created, right? A lot of people just really want to work for Disney, right? And so that brings a certain level of talent, to them, that allows them to, that they essentially have their pick of the litter, in this case, right? They have some technical things too that I think also create. It's not a significant advantage, I would say, but they have a lot of animation, talent that other people don't have, that you see with Pixar. Pixar has their own software that they use to make stuff. They share that with Disney, which allows them to create better animation and so forth. And they have a higher level of, that translates into big dollars in the future, right? And I think you can't ignore the fact that they have some of the most iconic franchises ever made, right? Star Wars, the Marvel Universe, and they know how to monetize those things. I mean, think about how much Star Wars was monetized before Disney did it, right? And they've made the same number of movies that George Lucas made, essentially in a much shorter period of time. Now you can argue whether those movies are a lot worse than the original trilogy or whatever, but people are still shelling out money to go see it, right? So they've definitely captured. They have an intangible asset that is almost impossible to quantify how much it's worth. And the best example I can give you is, Snow White was made in 1937, I believe. Snow White is still generating millions of dollars for Disney, how many years later, right? What is the value of Snow White? If you did a discounted free cash flow for that business, right? It's crazy to think about, right? That, this is a film that's almost, 80 something years old at this point, and has all of that, capability to bring people still to watch it, to still enjoy it and things like that. So how much merchandise do they sell just off of, that one movie alone? So it's an enormous aspect to this company that I think is, they have a very, very powerful capture of your mind share. Now, the question is, how much do they actually convert that into dollars, right?
Right. Yeah, before we move on to that question, I just want to comment on that. I think that's, the example that you bring up of Snow White is pretty powerful. And also the example that you bring up in terms of the Marvel studio and also like the Pixar and the underlying technology that's behind all of this creation of animation. That's something that is totally, we can certainly put them in the category of intangible assets, through which they exert competitive advantage over others. I certainly think that, pointing those out is a salient point there. But to your point, though, we need to think about how they translate into, how these things translate into dollars. So let's move on to subsequent questions. This one is really about, we just listed out competitive advantage. We need to talk about durability of them. I think you touched on a couple of them already when you talked about brand and so on and so forth. But give us some more color on the durability of their competitive advantage.
Well, I do think that they have a very powerful advantage, right? I mean, it is because of the where they play in the space of entertainment, right? And because they've captured so much mind share, I think it's hard for them to lose it, right? I think the fact that they have these cable networks and things like that, though, is where I really start to question the business model, right? So if you're making money off of 90 million subscribers who are paying you $5 a month or $6 a month for ESPN or $4 a month for Disney, and you're collecting $20 to $30 a month from people for doing nothing, right? They may not even be watching it. They may have subscribed to your cable package for some other reason, right? But you're able to sell this to cable companies with a huge, huge basically markup, right? But the real problem is that, as we've seen, and I think, especially people in their 20s now, they never sign up for a cable package. They're buying Netflix, Hulu, YouTube TV, some different combination of things. And, Disney Plus may be one of those. It may not be one of those, but, we're basically recreating the cable package just with streaming services. And, the real challenge that I think for Disney as a company is what is going to happen with their business, right? When you consider how much of their business comes from the media division, how long before that subscriber, iceberg starts melting to the point where it, falls apart, right? So the core brands and things like that are always going to be solid. But I am not, that's the part about this where I am not as clear, right? As the media networks and things like that, their business model is being disrupted, not because of a failure of their product, but because of the general trends of the industry.
Yeah, that makes a lot of sense. That makes a lot of sense. But just to kind of go back to harp on this question again, durability of the competitive advantage, just to make sure that we cover this point correctly. The competitive advantage itself, the stuff that you mentioned earlier on, right? The brand, the intangible assets, they still exist, but this now we're kind of looking at this through the lens of business model, and you're questioning the business model and how they're utilizing these competitive advantages. And I think the point that you bring up about almost cannibalizing their own business with the launch of launch of Hulu and Disney Plus and ESPN Plus, and the whole tectonic shift happening in this industry, with everyone moving over to subscription, streaming services instead of cable. It's obviously a very disruptive thing to the industry, and I guess the question is, this is going to happen. The question is, how much of that value can Disney capture, right? In this new business model, in this new paradigm of delivering content, how much value can they capture? Right. I think that's the question.
Well, and so I think that's kind of what we're going to spend a lot of our time talking about for the rest of this episode. This is more of a thought experiment to me than anything, because, to be honest with you, I mean, we can talk about valuation, but I don't think it's very interesting, right? But when you look at the businesses here, a lot of companies have gone to this streaming model with the intent that they're going to capture tons and tons of mind share, right? But then they fail to understand that this has now become a capital intensive business, right? And so think about other capital intensive businesses, like, the classic example that Charlie Munger talks about is, your construction rental service, right? And so you buy cranes and you buy all of these things, and then you rent them out to people. Well, yeah, you generate tons of revenue, right? But nobody wants an old construction crane, right? They want the new model. So you end up having to replenish your supply of stock and having to repair it and having to keep it in good shape. Eventually creates, your capital expenditure wipes out any of your earnings that you're going to generate, right? So now what I am generating $30 per subscriber for the cable package, and now I'm getting $7 a month for that same person on Disney Plus, right? Well, I mean, the math is just not going to work out, right? At the end of the day. So, you have to, if in order to keep the same amount of revenue, you're going to have to capture the same amount of revenue, in whatever business model you're doing, right? And when you think about it, you release a movie in the theaters, and it generates $1 billion, right? Well, when we actually get down into the studio business and things like that, that's a small percentage of their revenue relative to the parks and the media business, right? And so, this idea that yes, they have best movie studios and they have all of these things, it doesn't translate necessarily if the business model is going to cut off your nose to spite your face, right? That's effectively what's going to happen in the long term, right? Is that you're not going to sign up 300 million subscribers in the US because there's 350 million people in the US, right? So
Yeah. So effectively, like the average selling price, effectively, and we're just talking about this media segment right now, right? The effectively the average selling price of their services or their product dropped from $30 to, let's say, $7. Now they have to make up that delta with volume, but the reality is that you're not going to reach that many people because there's only so many people that are consuming it already. They're already that big. But I think we kind of maybe want to cast this against Netflix. And we talked about this a lot in Netflix podcast. If you haven't listened to it, please check it out. In Netflix episode, we talked about how they are basically forking over fortunes to create these original contents, right? And I mean, this is kind of going back to the target audience here, right? At least in Disney, if already a lot of these products have been made. You mentioned a great example, 1937, when Snow White was made. Disney is able to still continue to milk this product as long as we exist. But like in the case of Netflix, well, you create an original product that costs hundreds of millions of dollars. Are they going to be? Are we going to be watching this show 10 years down the road, 20 years down the road? Right? Probably not.
yeah, and I think there's the reason that Disney can survive that is that they can make a movie and then make up their money on merchandising and parks, right? Kids are going to want to buy toys and Lego branded things, from Disney. They're going to want to buy, surrounding ecosystem. And so Disney could essentially give the movie away at cost and use the long tail of the profits to generate it. How does Netflix do that in their model? Well, I don't think they can, right? They don't have that. I mean, yes, some people are buying Stranger Things t-shirts and things like that, but for the most part, that's not where they're going to make their money long term, right? Is they're making their money purely off the subscription fees. And the problem is that if Netflix stops making movies or stops making TV shows, well, then people stop subscribing, right? Or the value of the subscription drops significantly. So, so Disney has kind of an interesting setup in that they can monetize different aspects of the business. And in the second half of the podcast, or in part 2 of Disney, we'll actually go down into the finances and look at it, right? But when we're still thinking about this from the thought experiment side, is that if almost a third of their revenue is coming from the media side of the house, and that is going to be shifting, right, away as cable subscription packages die, right? And it's going to take a long time. It won't be tomorrow. It'll be 5 years from now that, but the cord cutting is accelerating, I think, as it goes on. And so how do they capture the rest of that revenue, and can they capture the rest of that revenue? Mm-hmm. Is to me the real question.
Yeah, that makes sense. And just one last point on that. It would be even more perilous to the company if they didn't do anything and set back.
Right.
I think obviously when you pit Disney with someone like Netflix, for example, or Amazon Prime, for example, they have a huge advantage because of all the things we mentioned, the brand, the original content that still people continue to enjoy today. All those things definitely help Disney, but at the same time, we have to think about distribution. Like the distribution model is completely being disrupted currently. And so how is Disney going to handle in this new age of streaming business? Like, they can't just like continue to stick with their old business model. They need to do something about this, right? And now the question for us as an investor is, okay, what is that going to mean in terms of valuation, right? What is that going to mean for, by putting a dollar, what is that going to mean in terms of return on equity, return on capital invested?
Well, so I mean, as we're we are obviously not Bob Iger, and we are not the ones running Disney, right? But there's different ways to think about this, right? You could produce the content and then give it to Amazon Prime, give it to Netflix, which, I mean, they put a lot of Marvel content on Netflix when they didn't have their own streaming service, right? And the idea was that it could be potentially higher margins for them, right? But then eventually Netflix gains the power over the content distribution, so they wanted to be part of this model of, we'll distribute our own content, pull it off of Netflix, pull it off of any other service, and then the only place you can find Disney stuff is on Disney. And that's why they went after Fox, is they expand the ecosystem by buying up Fox's assets of, worth $70 billion according to Disney. But then how do you monetize those assets, right? And that's ultimately the problem with any of this, is, can you even monetize it to make it worthwhile, right? That, if in the model where people go to the theater to watch a movie, right, they are spending money with their wallet and saying what I'm interested in watching, right? In this model, you don't actually know what made them subscribe, right? So you don't have the granularity of, it's the old story that a lot of people were subscribing to Netflix and all they watched was Friends reruns, right? And so, when those things go away, can Disney Plus, make it worth your while to stay on their platform, right? And can they make it interesting enough for you to stick around, or are you going to have people that are just going to move from one service to another, right? And I think that's kind of where there's a lot of unknowns here in this setup, because I think Disney wanted to control the environment, and maybe the answer is that they monetize it on the parks, the merchandise, etc., and maybe that'll work out. I mean, there's plenty of Star Wars crap that people buy, and Disney stuff and things like that. So maybe it does work out for them that way, but it's going to be a big chunk of their revenue. A third of their revenue is coming from the media arm, which won't go away completely, but it's going to get less and less over time.
Yeah. It's interesting. I know we have to go down the checklist, but I think this is really valuable discussion here. One of the other things that I want to talk about is who controls supply and who controls the demand. And if we think about this model for a little bit, like, take for example Amazon, right? Amazon has been a master at controlling the demand, right? Users go on. I'm just talking about their e-commerce platform, right? All of us, I think majority of us, have some kind of Prime membership, and you go on and buy it, and it's so convenient. You can just search for whatever item you want, and it's just a click away. So they've been really relentlessly going after controlling the demand, and then supply just kind of fell into its place because you're able to control the demand. Like, when we talk about Netflix and what Disney is doing in this kind of spectrum of controlling supply and controlling demand, Disney is attempting to do both, right? They have the content, which is the supply side, and then they also want to control the demand using their platform, like Disney Plus and ESPN Plus. They want to control the entire chain. And I think Netflix originally started off with controlling the demand, and now inching over the other way. Disney started off with content, supply side, and then moving on to the demand side. So it's like, Clash of Titans, but they're going kind of opposite direction, which is interesting to kind of think about.
Well, and I think the thing about it is, they're not direct competitors in the same way that most people think, right? There are plenty of people who have Disney Plus and Netflix, and so they can coexist in this world, but the problem with the entire business model of this is a monthly fee. I can easily switch between things if I need to. Netflix hasn't proven that they can maintain sustain a profit over a long period of time, right? And I think that they overpaid for a lot of content over a long period of time and eventually created, upped the ante on terms of cost to actually produce things, right? Whereas before, costs were tightly controlled. You had to control things, otherwise you'd run out of money, right? And they just started throwing tons of money at things, in order to make a higher quality product, which is not necessarily a bad thing in and of itself, but it does create a problem in that we are living in an inflationary time, right? Money is cheap, debt is cheap. It creates, people throw money into things to create more, because things become relatively cheap, they spend more money on stuff. I don't know that that'll last forever, right? I mean, production costs can't continue to increase faster than inflation forever, right? At some point, then something will have to give because people will either stop paying for it because Netflix will become too expensive and they can't afford it, or there will be a crash, and the people who will survive that, I think, will be Disney, because Disney is better suited for this because they have other avenues of they can sit and wait it out. And because they control so much of the media landscape, they can do that successfully. And like, if you want to work in Hollywood, you're going to have to go through Disney at some point, right? At some level. So I do think that there is a component of this that, you can't really, get away from in the world. But
yeah, we talked extensively about this. So why don't we just, just for the sake of discipline of going through the checklist, let's just fire off a couple of questions and then you can answer in a very short burst. Does that sound okay?
Yep.
Okay. So we left off at the durability. So moving on to the next question, long-term prospects and runway for growth.
Yeah,
people going to be consuming?
I think we've covered this, as best we can. I do think that they're going to be around for a very long time, and they have the mindset to do that, and they have the properties to do that. So I think it shouldn't be a problem. But I don't know that they'll be able to grow too quickly. I mean, they're a very large company to begin with. So
sure. Moving on to the next question: does the company require a lot of capital reinvestment to maintain its business?
Oh yeah.
Okay, it's a solid yes. Moving on to the next question. Do you have any color you want to add?
We'll talk. So we're not going to do the second half of the checklist in part 2. We're going to just talk about finances. So I'll defer that to when we go through the various financial statements.
Okay, great. Moving on to the last question of the episode. Does the company have favorable relationships with the following? Any red flags? Again, we're really trying to look for any major red flags that we see across these stakeholders. So customers, suppliers, employees, regulators, and community. Anything there?
I mean, you can conceive of something in every one of those categories, with consumers and regulation and things like that. But I don't know that it's super important to get into that. I don't think it adds much, to the discussion, really.
Okay. Sounds good. Okay. All right. Well, I think we had a kind of long-winded conversation about Disney, but I thought it was a good discussion, good valuable discussion, good thought experiment. Hopefully, you guys can join us for the second episode where we will talk in depth about the finances. All right. Thanks so much for joining. Hope to see you guys in the next episode.
Thanks.
Thanks.